So in this scenario, you got this property that's out in Napa that is on the market for $18 million. Let's say it sells for 18, they paid around 8, keeping it simple. You got $10 million in taxable gains. So what I hear you saying is they set up a trust. The proceeds at the closing don't go to Mr. Seller or Mrs. Seller, they go to the trust. And then you're not getting taxed immediately on this 10 million in profit, because through the trust, you can explain it from there.
Yeah, you're becoming the lender is what you're doing, right? And so the essence of an installment sale is you're taking back payments in installments, slowly over time. And so what the seller is saying is, look, I'll become the bank, I'll become the lender, and I will literally sell my property to the trust right before the trust sells it to the ultimate buyer. It's like a simultaneous close, okay? And then here's the key here. The trust, Michael, bought the property for $18 million. And turn around and sold it for $18 million. So if the trust bought and sold for the same price, Michael, what's the gain for the trust? Zero, right? So there's no gain on the trust. Now, and if the seller took a zero down payment, the trust really gave the seller zero down payment in exchange for a promissory note for the full $18 million, or what, minus the debt. Let's say they had $8 million of debt, so they have $10 million there or so. Then they get a promissory note for $10 million instead of having 7, right, after tax, or 6.7. They have 10, and that's where the math has got to make sense. We got to get the ratios. We got to find out if and where they need the money. If they're planning on using the money to buy another house, right, then they want to take that amount for the down payment to buy that next house. If they're planning on just living off the interest, right? Every scenario is a little different, and that's why we work on a conditional basis. We don't charge anything unless they do the deal, and we literally give a side-by-side comparison. Pay the tax, defer the tax, right? Yep. Let's walk through with your CPA, everybody, and see if it works for you.
And let's keep it simple. I'm a buyer's agent. I'm the buyer. To them, what's the difference for them through the transaction?
They get everything they're bargained for. So there's literally zero difference. In fact, in every single deal I've ever done, there's never been an issue with the buyer, as long as it's disclosed, pretty early on in the transaction, right? Sure. And that's important. We can also touch on timing. We need to set up this trust before the buyer removes all contingencies, right? Once the buyer removes all contingencies, from the IRS's standpoint, that's considered what's called constructive receipt. It's essentially going to be closing, and you're going to get the funds anyways. So that's taxable. But if we just have a day or two before that, we enter the Deferred Sales Trust, we form the trust, it gets a new EIN, we enter the language into the purchase and sale agreement on an addendum, then guess what? We can transact on this deal. Now, if you're an investment property and you're in a 1031 exchange, we can save a failed 1031 exchange. And that's at the qualified intermediary. That's a different topic, but we just recently did one in Georgia, a $7.6 million sale. We helped that gentleman save his failed 1031 exchange. But everything else must be done before close of escrow and really set up before the buyer removes all contingencies.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.